I lived through the 1970s. I watched inflation destroy wealth on a scale that people today, people who've only experienced the relatively stable prices of the past 40 years, simply can't imagine. I watched as the purchasing power of the dollar was cut in half over a single decade. I watched as interest rates soared above 15%. I watched as stagflation, the toxic combination of rising prices and economic stagnation, strangled the American economy. And I'm seeing signs today, troubling signs, that suggest we might be heading into a similar period. Not identical. History never repeats exactly, but rhyming strongly enough that I'm taking precautions. I'm positioning Berkshire Hathaway and my personal investments to survive and potentially thrive in a high inflation environment. Today, I'm going to explain exactly what I learned from the 1970s, why I think we're at risk of returning to that kind of inflationary regime, and most importantly, what I'm doing about it. Because if I'm right, the investment strategies that worked for the past 40 years are going to stop working, and the investors who adapt will do well, while those who don't will see their wealth evaporate. Let me start by taking you back to the 1970s, because most investors today didn't live through it and don't truly understand how destructive high inflation can be. In 1970, inflation was running around 5%, which already felt high compared to the stable prices of the 1950s and 60s. By 1974, it had spiked to over 12%. It came down briefly, then surged again, reaching over 14% in 1980. Think about what that means. If you had $100,000 in 1970, by 1980, the purchasing power of that money had been cut by more than half. You could buy less than half as much with your money as you could a decade earlier. That's catastrophic wealth destruction. But here's what made it particularly insidious. This wasn't happening because of a war or a natural disaster or some temporary supply shock. It was baked into the structure of the economy and the monetary system. The Federal Reserve had lost control of inflation. They'd print money to support the economy. Inflation would rise. They'd try to tighten. The economy would weaken. Political pressure would force them to loosen again. And inflation would come roaring back. It was a cycle that fed on itself, and it took nearly a decade and the most aggressive monetary tightening in American history under Paul Volcker to finally break it. The stock market during this period was a disaster. The Dow Jones Industrial Average peaked around 1,000 in 1966. 14 years later, in 1980, it was still around 1,000. 14 years of zero nominal returns. But remember, inflation cut the dollar's purchasing power in half during that period. So in real terms, the stock market lost over 50% of its value. If you were a buy and hold stock investor in the 1970s, you got crushed, even if you thought you were being prudent by owning quality companies. Bonds were even worse. Long-term government bonds, supposedly the safest investments available, were called certificates of confiscation by many investors. Why? Because they paid fixed interest rates that were far below the inflation rate. If you owned a bond paying 5% interest, but inflation was running at 10%, you were losing 5% of purchasing power every year. Bond prices collapsed as investors demanded higher yields to compensate for inflation. It was a generational disaster for retirees who thought they were being conservative by holding bonds. Now, you might ask, Warren, if stocks and bonds both did terribly, what did work? And the answer is specific types of assets and businesses. Companies with pricing power, businesses that could raise prices faster than their costs increased, those did okay. Energy companies did well because oil prices soared. Real assets like commodities, farmland, and real estate appreciated significantly. Companies with low capital intensity and high returns on capital could generate real returns even in an inflationary environment. But broad stock market indices did poorly, and fixed income investments were disasters. So what did I do during the 1970s? I focused intensely on finding businesses that could survive and thrive in inflation. I looked for companies with strong competitive positions, with the ability to raise prices without losing customers, with minimal debt, because debt with fixed interest rates actually benefits from inflation. You pay it back with cheaper dollars. I bought businesses outright through Berkshire, taking them private so I didn't have to worry about short-term stock price fluctuations, and I stayed away from long-duration assets, businesses that required massive capital investment to grow, and anything with fixed returns that would be destroyed by rising inflation. The experience taught me several crucial lessons that I've never forgotten. First, inflation is a much more serious threat to wealth than most people realize. It's insidious because it happens gradually. Each month, prices are just a little higher. Each year, your dollars buy a little less. But over time, the cumulative effect is devastating. Second, the traditional safe assets, government bonds and cash, are actually very unsafe during high inflation. They preserve nominal value but destroy real purchasing power. Third, the only real protection is owning productive assets, businesses, and real properties that can adjust their output prices to inflation. Now let me explain why I'm concerned we might be entering another period of elevated inflation similar to the 1970s. The parallels are striking and deeply concerning. Start with the fiscal situation. In the 1970s, the government was running deficits to fund the Vietnam War and expanding social programs. Today, we're running trillion-dollar deficits annually during supposedly good economic times. The national debt has exploded to over $34 trillion, over 120% of GDP. We're spending far more than we collect in taxes, with no plan to balance the budget. This matters because deficit spending is inherently inflationary. The government spends money into the economy, increasing demand, without corresponding increases in productive capacity. That excess demand chases limited goods, pushing prices up. The Federal Reserve's role is equally concerning. In the 1970s, the Fed repeatedly made the mistake of fighting inflation, half-heartedly, raising rates briefly, then cutting them again when the economy weakened or political pressure mounted. They prioritized short-term economic growth over price stability, and that failure of resolve allowed inflation to become entrenched. Today, I see similar patterns. The Fed kept interest rates at zero for over a decade after 2008. They printed trillions of dollars through quantitative easing. When inflation finally surged in 2021 and 2022, reaching levels not seen since the early 1980s, they raised rates aggressively. But now, even though inflation is still above their 2% target, they're cutting rates again. Why? Because they're worried about economic growth, about employment, about financial stability, all legitimate concerns. But if they cut rates too soon, if they declare victory over inflation prematurely, they risk reigniting inflation just as it happened in the 1970s. The structural factors supporting inflation today are also remarkably similar to the 70s. Back then, you had energy shocks from OPEC oil embargoes. Today, you have energy transition challenges as the world tries to move from fossil fuels to renewables without having built adequate renewable capacity. The result is energy price volatility and upward pressure on energy costs. In the 70s, you had demographic pressures as baby boomers entered the workforce and started forming households. Today, you have deglobalization and reshoring of supply chains, which is inflationary because domestic production costs more than offshore production. You have labor market tightness in many sectors. You have huge infrastructure needs that will require massive spending. All of these are inflationary pressures. Then there's the political economy aspect. In the 1970s, politicians were unwilling to accept the recession and unemployment that would be necessary to break inflation. They pressured the Fed to keep monetary policy loose. Today, we see the same dynamic. Modern monetary theory and other ideas that downplay inflation risks have gained influence. There's massive political pressure on the Fed to keep rates low to support economic growth. The idea that a little inflation is acceptable, even desirable, has become mainstream. This is exactly the kind of thinking that led to disaster in the 70s. But here's what makes me most concerned. We have far more debt in the system today than we did in the 1970s. Government debt is higher, corporate debt is higher, household debt is higher, and this debt creates a trap. If the Fed raises rates high enough to truly crush inflation, the way Volcker did by taking rates above 15%, the debt burden becomes unsustainable. Governments can't afford to service their debt. Corporations default Homeowners lose their houses. The financial system seizes up. So there's enormous pressure to keep rates lower than would be necessary to control inflation. The system is trapped between the rock of inflation and the hard place of debt default. This is why I believe we might be entering a period of chronic, moderate to high inflation, maybe not the extreme peaks of the late 70s, but sustained inflation in the 4 to 6% range or higher, persisting for years. And if I'm right, that changes everything about how you should invest. So what am I doing to prepare? Let me walk you through the specific strategies I'm implementing at Berkshire and in my personal portfolio. First, I'm focusing our investments on businesses with pricing power. This is always important, but it's absolutely critical in an inflationary environment. Pricing power means the ability to raise prices without losing customers. Some businesses have this naturally because they offer products or services that customers need and can't easily substitute. Others have it because of strong brands, network effects, or dominant market positions. Look at the businesses Berkshire owns. We own BNSF Railway, one of the largest freight rail networks in North America. Railroads have incredible pricing power because there's no alternative for many shipping needs. You can't just build a new railroad system. We can raise freight rates roughly in line with inflation, protecting our real returns. We own utilities through Berkshire Hathaway Energy. Utilities are regulated monopolies. They're allowed to earn regulated returns on their capital investments. As their costs rise with inflation, they can raise rates. We own insurance companies like Geico and our reinsurance operations. Insurance premiums are repriced annually based on current costs and loss expectations, giving us natural inflation protection. Even our stock portfolio is oriented toward businesses with pricing power. We own Coca-Cola, a company with one of the world's strongest brands. When Coke's costs rise, they raise prices and customers keep buying. We own American Express, which benefits from inflation because the fees they charge on transactions are percentages of transaction values. As prices rise and transaction values increase, their revenue automatically increases. These are the types of businesses that can maintain real profitability in an inflationary environment. Second, I'm avoiding long-duration assets. Long-duration assets are investments where the payoff is far in the future. Growth stocks trading at extreme valuations are long-duration assets. You're paying high prices today based on profits you hope the company will earn many years from now, but inflation destroys the present value of those future profits. If I discount future cash flows at a 6% rate instead of a 2% rate because of inflation, the present value of those cash flows falls dramatically. This is why growth stocks tend to perform poorly during high inflation periods. The 1970s crushed growth stocks while value stocks did relatively better. Long-term bonds are the ultimate long-duration asset, and I'm avoiding them like the plague. A 30-year Treasury bond is essentially a bet that inflation will remain low for 3 decades. I'm not making that bet. Even 10-year bonds concern me. I'm keeping Berkshire's fixed income investments in short duration securities, mostly Treasury bills maturing in less than a year. Yes, we have to roll them over constantly, but we also get to reinvest at current market rates. If inflation pushes interest rates higher, we benefit from higher yields. If I were locked into long-term bonds at today's rates and inflation surged, I'd be stuck earning inadequate returns for decades. Third, I'm increasing exposure to real assets. Real assets are physical properties that have intrinsic value independent of currency fluctuations. Farmland is a perfect example. Berkshire doesn't own farmland directly, but we own businesses that do, and I've personally invested in agricultural properties. Why? Because farmland produces food, and people need to eat regardless of what happens to currency values. During high inflation, the dollar value of the crops produced increases, and farmland values tend to rise accordingly. It's one of the best inflation hedges available. Energy assets are another category I'm emphasizing. Berkshire Hathaway Energy owns natural gas pipelines, electric utilities, and renewable energy installations. These are real assets that produce essential services. They can't be printed like money. They can't be devalued by government policy. And the revenues they generate tend to rise with inflation. I've also been buying more energy stocks in our portfolio, companies like Occidental Petroleum and Chevron. When inflation is driven by energy prices, which is often the case, owning energy assets provides direct protection. Fourth, I'm maintaining minimal leverage. Debt can be beneficial during inflation if you borrow at fixed rates and pay back with devalued dollars. But debt is also risky because it creates obligations that must be met regardless of business conditions. I prefer to keep Berkshire virtually debt-free. We have some debt at the operating company level, but at the holding company level, we maintain fortress balance sheet strength. This gives us flexibility. If inflation surges and interest rates spike and credit markets freeze up, we're not dependent on refinancing debt. We can operate our businesses and make investments while over-leveraged competitors struggle to survive. Fifth, I'm building businesses that require minimal capital investment to grow. Capital intensity is the enemy during inflation. If you need to constantly reinvest in equipment, inventory, and facilities just to maintain your current level of operations, and if the cost of those investments is rising with inflation, you're running to stand still. Your reported profits might look good, but you're not generating real returns because you have to plow all the profits back into replacing assets at higher prices. The best businesses during inflation are those with low capital needs. Insurance is a great example. We collect premiums, invest the float, and pay claims. We don't need to buy new factories or build new infrastructure. Service businesses generally require less capital than manufacturing businesses. Technology businesses, at least certain types, can scale without proportional increases in capital investment. These are the businesses I want to own during an inflationary period. Sixth, I'm holding more commodities exposure than I normally would. I'm not a natural commodities investor. Commodities don't produce anything, they just sit there. But during inflation, commodities tend to do well because they're priced in nominal dollars that are losing value. Oil, gold, industrial metals, agricultural commodities all tend to rise in price during inflationary periods. We've increased our exposure through equity investments in commodity-producing companies rather than direct commodity holdings because I prefer to own businesses that extract and sell commodities rather than the commodities themselves. Now let me address what this means for the average investor, because most people don't have hundreds of billions to invest like Berkshire does. The principles remain the same. First, focus on businesses, not financial assets. Own stocks of companies with real competitive advantages, with pricing power, with low capital intensity. Avoid chasing growth stocks trading at extreme valuations. Avoid bonds, especially long duration bonds. Keep your fixed income investments short term so you can reinvest at higher rates if inflation pushes yields up. Second, consider real assets appropriate to your situation. If you own your home, that's a real asset that provides inflation protection. Your mortgage, if you have one, is fixed in nominal terms, so inflation makes it easier to pay off. If you have the opportunity to invest in farmland, in rental real estate, in businesses, you understand, these can provide inflation hedges. Even small investments in commodities or commodity producers might make sense as portfolio diversification. Third, avoid leverage unless you really understand what you're doing. Yes, fixed rate debt benefits from inflation, but debt also creates risk. If you borrow to invest and your investments decline before inflation really takes off, you can find yourself in serious trouble. Only use leverage if you have sufficient income and assets to service the debt under various scenarios. For most people, staying debt-free, or at least minimizing debt, is the safer path. Fourth, maintain emergency reserves in cash or short-term instruments despite inflation risk. Yes, cash loses purchasing power during inflation, but cash provides optionality.
If inflation sparks a market crash, having cash allows you to buy assets at depressed prices. If you lose your job during the economic disruption that often accompanies high inflation, cash provides a cushion.
Don't be so worried about inflation eroding cash that you leave yourself with no liquidity. Fifth, invest in yourself. During the 1970s, the people who did best were those with valuable skills that couldn't be automated or outsourced, skills that commanded rising wages in an inflationary environment. Professional skills, technical skills, skilled trades all become more valuable. Your ability to earn income is your most important asset, and it's naturally inflation adjusted if you're providing valuable services that people need. The 1970s taught me that inflation is one of the most dangerous threats to long-term wealth accumulation. It's subtle and insidious. It doesn't announce itself with dramatic crashes. It just quietly, persistently erodes purchasing power year after year. And by the time people realize what's happening, much of the damage is already done. The investors who survived the 70s and came out ahead were those who understood inflation dynamics, who positioned their portfolios defensively, who owned the right kinds of assets, and who avoided the traps of long duration investments in fixed income securities. I'm seeing too many of the same warning signs today. Massive deficit spending, a Federal Reserve that seems unwilling to maintain tight policy long enough to truly crush inflation, structural inflationary pressures from deglobalization and energy transition, and a debt burden that makes aggressive inflation fighting nearly impossible. I don't know with certainty that we're heading into a 1970s style inflation regime. Nobody can know the future, but the risk is high enough that I'm taking precautions. I'm positioning Berkshire to survive and thrive if inflation does accelerate. And if I'm wrong, if inflation remains contained, the strategies I'm pursuing, owning quality businesses with pricing power, maintaining financial strength, focusing on real assets, these strategies will still generate good returns. That's the beauty of investing based on sound principles rather than predictions. You don't need to be right about every forecast. You just need to position yourself so that you do reasonably well across a range of outcomes. I've been doing this for 75 years through every kind of economic environment imaginable. The 1970s inflation, the disinflationary 80s and 90s, the bubbles and crashes of the 2000s, the zero interest rate period after 2008. Through all of it, the same basic principles have worked. Own good businesses at reasonable prices, maintain financial strength, be opportunistic when others are fearful, and adapt your strategies to the environment you're facing. Right now, the environment looks increasingly likely to feature higher inflation than we've experienced in the past 4 decades. So I'm preparing accordingly. And if you understand what's at stake, you should be too.